Hey everyone, welcome back to Marifolk's Crypto, the channel where you're subscribed for the latest Bitcoin news, price action, and all things crypto. If you're new here, welcome. Please subscribe, leave a comment down below, like this video, press the notification bell so you don't miss on any of my future videos. And if you are an experienced trader, go to the description of this video and claim your $200 bonus on BYBIT. Now this video is going to be different because this is the first part of my trading and technical analysis educational series, and in this video we are going to be talking about candlestick patterns and the anatomy of a candlestick. Make sure you watch this video till the end because this is the most important part of being a technical trader. Candlestick patterns is one of the trading systems which you can use on its own without any other trading tools such as different trading indicators. This is the first thing you learn as a trader and the basic knowledge for everyone who wants to trade. So let's begin. What is a candlestick pattern? A candlestick pattern is a method of reading a price chart. Candlestick charts are used by traders to determine possible price movements based on the past patterns. Candlestick charts are useful as they show 4 price points, open, low, high, and close, throughout the period of time the trader specifies. So if you are looking at a candlestick on a daily time frame, it means the high of the day. If you are looking at a candlesticks on a weekly time frame, it means the high of the week. So it can mean different things depending on the time frame you are looking at. When it comes to candlestick patterns, there are 2 main elements which we can use to classify it: a complexity and a type. This is important to understand because it will make things much easier to learn. And as I already said, candlestick patterns is one of the most important things, or even the most important thing that you want to learn to become a technical trader. Now let's look at each of these individually and break down the meaning. A complexity of a candlestick pattern means how many candlesticks compose the pattern. This method of classifying candlestick patterns relies only on the number of candles. And the first type is a single candlestick pattern. This means that only one candle is forming the whole pattern, and the shape of this candle will show us where the price will go next. There are also double candlestick patterns and triple candlestick patterns. So if a pattern is formed by more than one candle, we can call it a complex pattern. What is important to understand is that triple candlestick patterns will be stronger in comparison to single candlestick patterns. So you should learn single candlestick patterns first, then double, then triple patterns. Now let's look at the second element, which is a type of a pattern. There are 3 main types of patterns, and the first one is a continuation pattern. This means that when this pattern appears, the price will continue going in the same direction. The second type is a reversal pattern. Reversal patterns indicate that the price will reverse its current direction, which means that when this pattern appears, the price will go to the opposite direction. Reversal patterns can either be bullish or bearish. Bullish reversal pattern signals that the price will go up right after this pattern appears, and the bearish reversal pattern means that the price will go down immediately after the pattern appears. Both continuation and reversal patterns can be either bullish or bearish. The last type is a neutral pattern. In a neutral pattern, there is no such thing as a bullish pattern or a bearish pattern. Neutral patterns indicate a momentary stop in price. So in a neutral pattern, price can either be going up or going down, and when this pattern appears, it means that the price has momentarily stopped advancing in its current direction. The neutral patterns do not show us where the price will go next. So this was the overview of 3 types of candlestick patterns, and now let's move to the candlestick construction. So what is a candlestick? A candlestick is a representation of price during a specific time period. A candle like this can represent a year, a month, a week, a day, an hour, and so on. It all depends on the time frame you are looking at. And during this time, each candle has an open, a close, a high, and a low. As soon as the candle starts, this is considered the open of the candle. The body of the candle is the part between the open and the close. In a green candle or a clear candle, the open is at the bottom and the close is at the top. A green candle represents a bullish candle, meaning that the candle closed above where it's opened. In a red candle or a shaded candle, the open is at the top and the close is at the bottom. This is the only difference between a green or clear and a red or shaded candlestick. During this time, you can get to a higher point and create a high, and get to a lower point and create a low. These are called shadows or wicks. Shadows show you what happens with the price between the open and the close. They indicate how high and how low price got during this trading period. What is important is that a candlestick does not tell you when the high was made or the low was made. It is possible to open here, go all the way down and make a low, then go all the way up and make a high, and then come back down and make a close. So you can only see the final result. Now we're going to look at single candlestick patterns. In this video, we will talk about 3 most important single candlestick patterns, but I will probably make a separate video to talk in details about each candle, so make sure you subscribe to my channel. Now, candlesticks give us a lot of information. The first candlestick that you must learn and understand is a Doji candle. The Doji candlestick chart pattern is a formation that occurs when the market's open price and close price are almost exactly the same. There are different variations of the pattern, namely the common doji, gravestone doji, dragonfly doji, and long leg doji. A doji candlestick is formed when the market opens and bullish traders push prices up while bearish traders reject the higher price and push it back down. It could also be that bearish traders try to push prices as low as possible and bulls fight back and get the price back up. A doji tells traders that neither buyers or sellers are gaining. In other words, a doji indicates indecision which can be neutral or lead to an imminent reversal in trend. The body can appear in the middle of the candle, at the top of the candle, or somewhere in between. The probability of a trend change increase, especially if the next candle is trading below, above the low or high of the doji. The next candlestick which I want to talk about is a hammer. The hammer candlestick pattern is formed of a short body with a long lower wick. Doesn't matter which color, and is found at the bottom of a downtrend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. So a hammer candle represents a bullish signal when found in a downtrend. The long lower shadow indicates an exhaustion of sellers. The shooting star candle is basically the opposite of a hammer. It occurs in an uptrend and represents a bearish signal. The way to identify a shooting star is to ask the question, is this candle higher than previous candles in the swing? Is the tail at the top significantly longer than the body? If the answer is yes, then this is a shooting star. It has a small lower body and a long upper shadow. There is also no or very little lower shadow. The long upper shadow indicates the exhaustion of buyers. Now we're going to look at 3 double candlestick patterns. The first one is an engulfing candle. Technically, an engulfing candle is any candle that completely swallows the prior candle. But in order for it to be a reversal candle, the candle has to be of the opposite color or shade. In the left picture, you can see a bullish engulfing candle, which occurs at the end of a downtrend. Even though the second day, if this is a daily time frame, opens lower than the first, the bullish market pushes the price up. And in the right picture, you can see a bearish engulfing candle, which occurs at the end of an uptrend. It signifies a peak or a slowdown of price movement and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. The bigger the engulfing candle is, the more powerful the signal. The next double candlestick pattern is Harami. The Harami candlestick pattern is considered a trend reversal pattern that can either be bullish or bearish depending on the direction of the price action. It signals a reversal when occurring after a downtrend or at the top of an uptrend. You need a smaller bullish candle after a bigger bearish candle, or a smaller bearish candle after a bigger bullish candle. The most important aspect of the bearish Harami is that prices gapped down on the day 2 and were unable to move higher back to the close of day 1. This is a sign that uncertainty could be entering the market. A bullish Harami occurs at the bottom of a downtrend when there is a large bearish red candle on day 1 followed by a smaller bullish candle on day 2. Again, the most important aspect of the bullish Harami is that prices gapped up on day 2 and the price was held up and unable to move lower back to the bearish close of day 1. The last double candlestick pattern, which we will talk about in this video, is a kicker. This is one of the most important, powerful reversal signs. The kicker pattern is one you need to know. It signals a massive shift in the sentiment of traders, often completely reversing the trend. It kicks off a decisive move with volume in the opposite direction, involving a significant gap. This gap may or may not close because breakaway gaps do not have to close. Kicker patterns are either bullish or bearish. Bullish kicker starts with a bearish candle and then show a bullish gap. Bearish kickers start with a bullish candle and then show a bearish gap down. Speaking about triple candlestick patterns, I will make a separate video on this topic because I want to keep this video short, so make sure you subscribe to my channel to not miss any of my future videos. And if you are an experienced trader, don't forget to claim your $200 bonus on BYBIT. The link is in the description down below. Press the like button, press the notification bell, leave a comment down below and tell me if this video was useful for you and what topic you want me to cover next. Thank you so much for watching, and I will see you in the next one.